You're listening to The Intellectual Investor, episode number 21. Here's why pharmacy stocks are a bargain right now. Written by Vitaliy Katzenelson and read by Elliot. To read this article online or to listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Here's why pharmacy stocks are a bargain right now. My investment management firm's portfolio has a large position in the healthcare sector. And with AbbVie's $63 billion takeover bid for Allergan earlier this week, it's timely to review why we bought into this sector. Without commenting on Allergan shares of which we own, or AbbVie, which we do not, healthcare companies in general are non-cyclical. Healthcare consumption is stable and independent of the whims of the global economy. The world's population is aging rapidly, and as people get older, they consume more healthcare services. This creates a strong tailwind. These are good businesses. In general, they have solid balance sheets, above-average returns on capital, and they generate a lot of cash, which is used to pay dividends and buy back stock. These defensive features have not mattered much lately, as we're entering the 10th year of uninterrupted economic expansion. Accordingly, these companies are significantly undervalued. How undervalued? Let's answer that question by examining two stocks in our portfolio in closer detail. We'll start with McKesson. The media, mainly 60 Minutes, has likened drug distributors' exposure to opioid lawsuits to Philip Morris International's $150 billion tobacco settlement. Yet comparing Philip Morris to drug distributors makes no sense. The job of these well-regulated companies is to deliver FDA-approved drugs produced by FDA-approved manufacturers and sold by DEA, that is, Drug Enforcement Administration, approved pharmacies. The opioid crisis in the US is a true tragedy, but drug distributors are not responsible for it. An important point to remember when you read another heartbreaking article. The most likely conclusion to this fiasco is that drug distributors will either settle these lawsuits for a few $1 billion collectively. Keep in mind McKesson earns more than $3 billion a year. Or they'll get dismissed by the courts. A Connecticut judge already dismissed one case. Wall Street estimates McKesson's per-share earnings will grow to $18 from $14 over the next 3 years, and our estimates are very similar. McKesson stock is trading at about $130. And in the second half of 2019, the company will spin off Change Healthcare, in which by our estimates is worth $20 to $30 a share. If you take out Change Healthcare, investors are paying around 6 to 7 times earnings for this stable and still growing business. McKesson should be trading at 13 to 17 times earnings. We'll settle for 15 and value McKesson shares at around $250 to $300. If this analysis reads like a broken record, it is. Despite the additional research we've done, our thinking on McKesson has not changed, while the company's fundamentals have only improved. Next is Walgreens Boots Alliance. Our initial analysis of Walgreens Boots Alliance projected 3% to 5% revenue growth, stable margins, and earnings per share growth of about 7% to 8%, helped by share buybacks. The last quarter has thrown a wrench at these assumptions. Despite growing revenues, reimbursement pressures and the lack of new generic drugs have reduced Walgreens' pharmaceutical margins. There is a good chance that last quarter's performance was a bit exaggerated by temporary events, but it is likely that our assumptions of stable margins need a revisit, though we still believe volume will continue to grow as the aging population gulps more drugs. Over the past few months, we have spent a lot of time reanalyzing Walgreens, trying to figure out the worst case for earnings. Walgreens' US pharmacies historically made about $11.50 to $11.70 of gross profit per script filled. The average store filled about 340 scripts per day. In the latest quarter, by our estimates, Walgreens' gross profit per script declined to $11.20. In an attempt at killing the business, we assume that gross profit per script declines to $9, a drastic assumption. But even then, we could not get Walgreens' core earnings to less than $5 a share a few years out. At a conservative, no-growth price to earnings of 10 times, Walgreens' core business is worth about $50 a share. In addition, Walgreens owns about 26% of AmerisourceBergen, McKesson's competitor, which is worth another $5 to $10 a share, bringing our worst-case valuation of Walgreens to $55 to $60 a share. The stock's current $52 price is just under our worst-case scenario's fair value. Any positive development to the company should present upside for the shares. Moreover, Walgreens' market share has grown consistently. Walgreens and CVS Healthcare together control almost half the US retail pharmacy market. Walgreens and CVS market shares are 22% and 24%, respectively. Their stores fill larger volumes of scripts than smaller pharmacies, and thus can stay profitable at lower gross profit per script. At $9 gross profit per script, that is the assumption that we use when trying to kill Walgreens stock, smaller, lower volume pharmacies would start dropping like flies. It is unlikely that the insurance companies and the government would want this, but if it happens, Walgreens will be the beneficiary, as its market share will rise at an even faster pace. Our original expectation that Walgreens will earn $8 in a few years may prove to be too optimistic. Today, the street is projecting per-share earnings to grow to $6.50 from $6 over the next 3 years. We're not sure whether the street is right or wrong, but we don't totally dismiss the possibility of Walgreens earning $8 a share in a few years. In our original analysis, we valued Walgreens as a growing enterprise, and thus gave it a price-to-earnings ratio of 15. So at $8 of earnings per share, our fair value was $120. If Walgreens struggles to produce much growth, it will likely trade at 12 to 13 times earnings, deserving a per-share valuation of around $80. Walgreens' CEO, who owns 13% of the stock, and the company's management are not sitting still. That is why it is dangerous to draw straight lines through the negative articles you read about Walgreens today. The front end of the store, which occupies 80% of the real estate and generates only 25% of sales, is an underutilized asset. Walgreens is bringing LabCorp into 600 of its stores. It is working with Kroger to bring Kroger groceries and lower pricing to its stores. Walgreens has a deal with Microsoft to improve its technology. It is working on bringing Boots Cosmetics to 3,000 of its stores. Boots dominates the cosmetics market in the UK and has its own successful private label brand. Yet, even if Walgreens management doesn't succeed in growing earnings, at today's stock price we see little downside, no permanent loss of capital. There is also an upside to the recent setback. First, Walgreens is spending billions of dollars on share buybacks. The recent weakness in the stock is allowing the company to buy more shares. And second, the setback has brought an urgency to the company to improve its front-end store, that is, non-pharmacy business. If you look solely at the recent performance of healthcare stocks, you'd think these companies were on the verge of going out of business. Nothing can be further from the truth. These companies are profitable enterprises which generate enormous cash flows that will probably only continue to grow over time. Thank you for listening. This and other investment articles by Vitaliy Katzenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast, titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.